Alright, this is a range, and let's say price is trading inside the range. It goes higher, finds resistance, comes back down, finds support. It's trading somewhere like this and then goes higher. This is the day's VWAP. Now, whether it stays above VWAP, goes below VWAP, whatever happens, all the activity here is controlled by shorter time frames. Alright, so they are the dominant time frame. Now, higher time frame is also involved in all these areas, but they are trading in such a way that they are not affecting the price too much. All right, so they don't want to move the price too much. If the prices come towards the top and absorb the supply and goes higher, this is where higher time frame is actively affecting the price. On the other hand, if it absorbs demand and breaks down, so this consolidation, absorption of demand and breaks down, higher time frames are actively involved. Here, if it comes to the top and gets rejected, status quo time frames sold. If it comes to the bottom and gets rejected, status quo time frames bought. And here, in both these cases, higher time frames are not interested in affecting the price too much. So they are just calmly accumulating in this whole region. Once their accumulation is done, either absorption of supply or demand will happen and the market will move directionally. Till that time, everything happening in the central portion of the range controlled by shorter time frames, at the edges controlled by status quo time frames. This is how the time frames coexist, intersect and interact with each other, in the words of legendary Jim Dalton.